Today we're going to be discussing a super important topic, and it's basically the core of my entire three-step distribution model, finding bias and understanding time frame alignment. Pretty much this is the foundation of my model. It's what a lot of you probably struggle with. It's what I used to struggle with as well. But I'm going to be going over the solution on how to simply find bias and what it means to align time frames and how to understand that. Okay? So, let's simplify this. We are going to split the high time frame and the low time frame into two separate columns. These are separate things. They are separate categories. What we need for these to do, or for these two time frames to do, is we need them to align. When they both follow our same directional bias, that is when we are going to have a very high probability situation. Now, what do I consider high time frame? I'm considering the high time frame the hourly, 4 hourly, daily, whatever. Okay, usually hourly and 4 hourly. If we're intraday trading, the daily and weekly they are relevant for the highs and lows in areas of liquidity, but we're not necessarily going to align time frame from the weekly all the way down to our 1 minute or 5 minute execution. We don't want it to be that complicated, right? So, what is the high time frame going to tell us? Well, it's going to give us a very obvious direction if we are going to go higher or lower. Well, thank you. No shit. The market can go in two directions. That's very helpful. Well, when you're looking at it on the high time frame, yes, you can quite literally simplify finding either price going up or price going down into two directions. What gets complicated and what a lot of you are struggling with, and you might even be neglecting the entire time frame, you might not even consider this, is the low time frame. The low time frame is where for our bullish example, sorry, price is going to look like this. Oh man, like what is happening, right? This is what your candlestick is going to look like internally. On the high time frame, it's this simple. We go up. On the low time frame, we do all this shit internally. And obviously this is not a real drawing. It's pretty crazy and a little over exaggerated, but you guys get the concept. Same thing going down, right? On our down close candle, we're going to have all of this junk going down. How do we know A, which direction price is going to go in, and B, how are we not going to get stopped out on all these pullbacks and retracements, and how do we even know it's a pullback or retracement? If we're only looking at the time frame, the truth is we don't know. We don't know, okay, guys? And you guys, it's probably a struggle you guys face is that we are only acknowledging the low time frame, right? As human beings, we're wired to want action, right? We want our neurons firing, okay? The high time frame's boring, right? We only see this. We don't care about this. We don't want to trade this. We want to catch all of the fun stuff internally, but we cannot have fun internally unless we understand the external first. So or I want everybody watching this video to separate these two. I want you to go into this with a new mindset. So we are going to separate these two and align them. All right, one cannot go without the other. They have to be holding hands. They're a happy couple. All right. So now you guys have the overarching theory behind what we're going to be going over. Now, how do we actually identify it, right? I haven't gone into, obviously you can tell if we're going higher on the high time frame. Obviously it looks terrible on the low time frame. How do we actually align this? Okay, so let's actually get into it. Let's talk about it. All of your high time frame biases should be stemming from a manipulation or delivering from a high time frame fair value gap. Simple as that. And you might say, well, yeah, simple. How do we identify the manipulation? Bingo. I am going to be showing you the simple steps I take to find super high probability manipulations in order to give us our high time frame bias. So we have our first step. Remember, this is a step-by-step process. We don't even care about the low time frame yet. We need the high time frame. Ooh, we need the high time frame. Okay. So on our hourly chart in this example, what do we see? Well, we have some resting highs and lows, which I identify as key levels. This is the first step to identifying manipulations for me. All of these high time frame highs and lows can be considered key levels for me. Potential areas of liquidity, right? We know we manipulate from liquidity in the market, or we should. If you're watching this video, you should have a basic understanding of liquidity. We can expect manipulations to occur at these levels, but there's so many of these levels. How do we shake out some of the irrelevant ones or the less probable ones? It's as simple as adding another confluence, an SMT divergence, your divergence and correlating or your divergence in market structure with your correlating asset pair paired with this sweep of liquidity on your high time frame. Okay, so key levels are high time frame highs and lows where we expect liquidity to be swept, and it can be literally any high or low, by the way, or high time frame fair value gaps. But just to simplify it, literally this high is the high of a fair value gap, but you don't even have to think of it as a fair value gap because it's just a high, right? So keeping it simple, that's how we're going to identify our key levels. Let's play out the next candle. What do we see happen here? Well, we see price sweep out a key level, and when I say sweep, I mean we have a wick through this key level and we do not have a body closure through. What else makes this a high probability key level to identify our manipulation is the SMT. Key level SMT equals manipulation. Look at this. And oftentimes, I also don't necessarily like to use my divergences from such, long periods of time away. But this is an example I actually took live. So this isn't even like a hindsight example or a replayed example. I took this trade live. So we're going to let it slide. I do trade with SMTs sometimes from this far, but I like my manipulations and liquidity sweeps to occur in a more recent time period. Just wanted to point that out. But anyways, we have our key level SMT. And again, what does that tell us? Price is manipulating at this area and following the understanding that price wants to distribute from our manipulations. What can we tell or what can we anticipate price is going to do? Going to distribute. Going to distribute. And you can even see it here, right? You could have actually caught a trade on this entry as a whole, but we're going to use this example to show that all this is doing is identifying a manipulation. So what have we just done? We have just checked off the time frame, right? Bang, high time frame, done. And which direction is it? Bullish. Why is it bullish? Because we are manipulating lower to distribute higher. We now need to align the low time frame because again, now we're going to get into all the choppy mess. We need these two to align and then both still go in the bias or in the bullish direction. Pretty straightforward, right? So first step, check. We can start looking into our lower time frame. Now, how do we understand price internally? Well, we have to use time frame alignment and we have to align time and price. And it's actually pretty simple. A lot of people overcomplicated it. But it's called the open low high close or the open high low close. A lot of you may understand it already, but since we have our manipulation and we're anticipating our bullish candle to go higher, what do we think is going to happen? Well, we think, or actually, let's take a step back. I'm getting ahead of myself. Excuse me. We need to identify the anatomy of these candlesticks first, right? What do all of these high time frame candlesticks have? What do they all have? Wicks. They all have wicks. And on the low time frame, what does that look like? It looks like we open higher, or open, manipulate, put in the wick, distribute, or in this example would be the opposite, excuse me. Price opens, manipulates lower, putting in the low of our wick, and then we distribute, since we're expecting bullish price action. So now that we have our high time frame bias in place, we expect this to simply be an up close candle on an hourly time frame. We need to align time and price internally. So we can actually look at this example here stemming from our high time frame manipulation. If we look at our low time frame, the 10 a.m. candle opens, manipulates lower, sweeping out our high time frame key level or our high time frame liquidity, distribute higher, and closes. What gives us the confirmation that we're not going to just resweep this low? Change in state of delivery. What is a change in state of delivery? It's simply the shift above, or it's a body closure above the manipulation leg. So you see, this is the price leg on the 5-minute time frame that took us lower, that swept out liquidity, and we distribute above it. We get a shift in structure, and you can actually enter on this candle as a 10 a.m. open low high close, just like this. Shift or enter at the shift because this is your confirmation, and you've identified an area of invalidation. This is supposed to be the low of your hour. So when you guys are looking at the low time frame, we need to still think of high time frame areas of invalidation. We don't want price to go beneath here. Okay? And we can literally find any internal entry model we want here. I'm not trying to enforce internal entry models in this. I'm trying to show you the importance of high time frame and how that can simplify your internal time frame, right? So I don't necessarily focus on internal entries in this video, but you're going to see how we're going to make everything follow the same direction. Okay, so you could have actually entered on that 5-minute change in state. I'm not going to do that for use that entry for this example because we can have a much cleaner execution here, and this is the execution I took. And also, what's some things we're noticing? Here's some secret little sauce as well. We are manipulating beneath true day open, which is a time-based discount, right? You can look at the true day open, which is just midnight open New York time, which is you can either chart it out or have an indicator for it. If we are trading beneath the true day open, we are in a discounted area of our daily candle. We're in the bottom of it, right? So we can technically fractalize this system even higher and think we're putting in the low of our daily as well. We've manipulated lower on our hourly time frame. We've put in the bottom of our daily wick here even potentially, right? And also, what do we notice have what do we have resting above this manipulation? We have clean draws on liquidity. We have clean session highs resting, oh sorry, above these highs. We are anticipating price to distribute here. Simple as that. Draw on liquidity doesn't have to be difficult. It can literally just be high time frame highs and lows or session liquidity resting above your manipulation. So now we have our targets in place, we have our bias in place. Let's align time for an entry. And what do we have happening right now? So that was our previous hour close. In hindsight, you could have taken an entry on that, but let's say we didn't. And now we're scared about a retracement. We're scared about a whole bunch of things. How do we know where our stop loss is going to be, what the manipulation is going to be? We're going to use another open, low, high, close because again, our bias still hasn't changed. We know we want to expand higher to these draws on liquidity. So what does our next candle have to do? Open, put in the bottom of our high time. Oh, sorry, that wasn't very clean. Open, put in the bottom of our high time frame candle's wick, distribute higher. Okay, so we need to catch the low. We want to catch the manipulation at the low of this wick. So we can go to our low time frame. We can check out the 5-minute, the 15-minute. We're simply looking for any area where we can potentially manipulate lower from our open, low, high, close. Oh, sorry, I didn't play price out, I don't think. Okay, pardon me. So now we have our new hourly open. Okay. So the hourly candle opens here at. Oh, sorry, my replay mode's messed up. It does open here. What do we notice off the rip? Open, low. What do we think is going to happen after the low? High close. So how do we identify what's going to be the low? This is where we look for our low time frame internal PD arrays. Your 5 minutes fair value gaps, your 15-minute. I don't even have really strict criteria for this. Okay? You're just looking for an internal PD array to get hit with a shift in structure. Oh, sorry, I sped this up a little bit. But what did we see happen? Price taps into a 15-minute fair value gap. We have internally rebalanced. What do we think this rebalance is going to do? We think it's going to put in, where's my brush? The low of the hourly candle. Similarly to the bottom of this manipulation, we now have an internal area to place our stop loss. We don't want price to come back from this level if we get our internal change in state of delivery. Same process for the open, low, high, close of our manipulation. The open, low, high, close aligning time and price following that same high time frame bias. And what do we see happen? Just that. We respect our 15-minute gap. We shift above our, I'm going to remove the hourly candle, our manipulation leg, just like this. And again, look at this. It's the same thing. Same thing. We expect this to be a protected low. Now we can take our entry here and we can target to draw on liquidity higher. And a lot of you guys are probably thinking, man, I like my 1-minute entry models. I like, the 5 minutes a lot. This is a really big buy side liquidity. Maybe our stop is massive. Like, what are you doing? Nothing is stopping you from catching any of your internal entry models. You just have to understand that this is your true area of invalidation for your open, low, high, close. This is going to be the low of the hour. You can take whatever entry model you want in here, but I would recommend waiting for another internal manipulation. Like if you get a soup and an SMT here, then you can enter and use another internal stop loss here. But we cannot be catching trades and then just placing stop losses randomly internally. And also, we can't get scared about stuff like this. Notice how I haven't even talked about the bearish time frame internally, because that's irrelevant. I have not stressed once about any reversals or any internal shifts in structure because we know that's not what we're looking for. We've automatically taken a lot of stress off of our minds because of our high time frame. Just, simple. We want to go higher. So it's taken a lot of stress. I don't even care about reversals. I'm only looking for confirmations for my bullish structure, right? So I don't think this is going to be a liquidity sweep. I don't care what's going to happen here. I'm only looking for my bullish confirmations. All right. So I personally take my entries off of the 5-minute change of state of delivery because that's all of the confirmation I need. You guys can feel inclined to take literally any of your other internal entry models. You can align this open, low, high, close, and then after you get your confirmation, fire away, man. Take any internal entry model you want. Just be aware of internal protected lows. So let's take this example and let's play it out. I already know what's going to happen. I took the trade. Spoiler alert. Let's play it out. Shocker. Okay. Now, why do I not care about any of this? This also must have been a news release or some. Actually, it was like noon. I don't even know what happened here. But we had a protected low. It is no coincidence because, like I said, any of these lows are up for grabs. How come this one's not? It's the manipulation off of our open, low, high, close. A protected area in price. This is just not going to get touched. Okay, or it shouldn't. It's not going to happen 100% of the time, but it's very high probability. Once all these confirmations are in place, it's money, right? That's what you want to see. Let's recap this. Let's break down the steps. Your step 1 is your high time frame bias, which is your key level and SMT. What is this key level and SMT? It is showing you your manipulation. Okay, so if we look at our example here, the key level and SMT was the sweep of this previous hour low paired with this SMT over here. And SMT is just your diverging market structure, so you'll notice on our correlating asset pair, the British pound just never took out the low. So that's where your SMT stems from. So we have our high time frame sweep of liquidity and our diverging market structure. This is what gives us this narrative that we want to go higher. What's our step after our next step after we find this high time frame narrative? We are then looking to align price internally. How did I do that? How did I align both time and price and align it with the bias? The open, low, high, close. The 11 a.m. candle opens, manipulates lower, putting in the bottom of our wick of our new hourly candle. We shift structure, giving us all of the confirmation we need, and we're simply just targeting opposing areas of liquidity. This was hit for a 2.66, right? And you expect price to distribute. After manipulations, you think price is going to really rip there, okay? So the main thing I want you guys to take away from this video again, and I've said it 5 times because that's the point of this video, I'm trying to really pound it into your guys' brain, is because we need to differentiate the internal time frames or our low time frame with our external. These are 2 separate things and one cannot go without the other. So the next time you think your bias or you take a trade on the low time frame and you think your bias is good because you had your 2022 model show up, you saw your internal liquidity sweep, your breakup structure. Actually, let's look at this example. Right here, we saw our liquidity sweep, we saw our breakup structure with displacement. How is this not a perfect 2022 model? Where is the high time frame bias? We've only pattern traded this internally. Also, ignore the outrageous emojis in my bar. Okay, I'm sorry about that. But we've ignored every single context and we've only pattern traded this internally. Every step of the way through this, we had our guardian angel on the high time frame telling us which direction. We never once stressed about reversals or which direction we were going in because it was our first step. Okay, and from there you're just aligning time and price. This was a game changer for me in my trading. Quite literally, once you understand to follow the high time frame narrative and how to align time and price, you can take super shitty entries. Like this trade, we literally took drawdown, but we understand where our protected low is and we understand our bias. That is a game changer, and it's what led me to profitability, and it's what this system has shown me. So this 3-step distribution model and understanding manipulations in your high time frame bias is killer. I want you guys to try trading with this new mindset. high time frame and low time frame, two separate things. One cannot go without the other. They got to act as a happy couple. Try this in your new trading. I can't wait to see the results you guys have. I can't wait to see your success, even just from implementing this. You can keep the same entry model. But yeah, that's pretty much all for this video. I hope it was helpful. Please leave any comments, and I look forward to seeing you in the next video.